Hello, everyone, and welcome to the Buck Stops here. I am Catherine Murray. Well, we're going to focus on the U.S. markets today, do a little bit of a deep dive in terms of how to be positioning yourself, particularly given the fact that the markets in the United States have been so strong as of late. What are they pricing in? Is it too late to get in? And what is 2024 going to look like? For thoughts and insights on that, we have Chance Finucane joining us. He is the CIO at Oxbow Advisors. Chance, great to be with you today. Thanks so much for joining us.
Yeah, great to speak with you again, Catherine.
Thank you. So, Chance, it is interesting when you take a look at the markets. It really does feel as though investors are pricing in a soft landing, a perfect landing. From your perspective right now, I want to take a look at the economy first and foremost in the United States. What are you looking at, and what's your current view?
We have more of a defensive view. We think that the economy is continuing to slow. There are a set of leading economic indicators that are tracked in the United States that are updated monthly, and we're on 19 or 20 straight months of those leading indicators declining. And that tends to set up for more of the real-time indicators of economic growth slowing and then potentially turning negative. So with that slowing, we're also seeing the consumer, which is such a big part of the US economy, start to weaken a bit as well. We got the update on job openings in terms of the employment data. That looks a little bit weaker. To touch a little more on the consumer, though, we are seeing there is this huge rise in excess savings that we had up until like the end of 2021, and that's been steadily coming down. About 80% of that has been depleted, and we think that that excess savings from all the stimulus that was provided to individuals in the U.S. will be pretty much gone within the next 6 months.
Chance, what are some of the leading indicators, though, that you're looking at that do cause you to have concern or to be more defensive in the current positioning?
Yeah, it's common to look at new orders in that ISM manufacturing index that's released monthly. You also can look at some indicators related to the housing market, some sentiment data there. None of it's really turned and become to look more positive. And if you just look at the latest manufacturing survey that came out earlier this week, you're starting to see that turn to where it's actually seeing the employment data contract and decline. And that's something we've been waiting for. We're back to a point now where the job openings compared to the number of unemployed persons in the United States is getting back to about the level that we saw in 2018 and 2019. It used to be there were so many openings, 2 openings for every unemployed person a couple of years ago, but that's rapidly normalizing. And we're seeing more people that are unemployed for 15 weeks or longer. And that just means that we're getting back more to a more normal economy. And we think that's going to work its way into slower growth and a tougher environment to be investing in stocks.
Okay, and we'll get to the stocks and investing in a moment, but I continue to be curious with the economy because I was recently in the United States, and to me, it did feel slower. It felt like there was literally less traffic on the roads, less traffic in the stores, in the restaurants. Um, and that's always anecdotal, but I also think it's important. Now, you have to have a comparison. You need to have been in the States the exact same time period. A year ago, I used to do equity research covering specialty retail companies, and you go into the store at the exact same time to see if the promotional activities increased or decreased or what have you, and what the markdowns look like. But that's anecdotal to me. What are you seeing on the ground floor?
Well, to your point, to back up the anecdotal data that you were looking at and sort of experiencing when you visited the US, the leisure and hospitality jobs added when we're looking at this new monthly data are finally starting to deteriorate. And that was one of the strongest places for jobs being added in the United States in the last few years coming out of the pandemic. And now you're starting to see those businesses, whether it's retail or restaurants or hotels, are starting to pull back and they don't need to
Hmm.
hire as much. And we think that's going to be a bit of a headwind going forward.
I did notice that. I think, are you referring to the ADP report yesterday on the private side that showed it was down by about 6 or 7 thousand in the hospitality and leisure?
Yeah, yeah, and we'll see. There's that survey, and then there's also the non-farm payrolls report that will come out later this week. And sometimes those two don't add up to the same numbers, but we do think that you're going to see that weakness that we're seeing in the job openings data, the JOLTS data that came out recently, that has just been in a steady downtrend now for a couple of years. We think that will slowly start to work its way towards weakness in the payrolls data.
Okay. And then, of course, what's been so interesting, of course, is that the market continues to move higher. We'll take a quick break. We'll be right back.